Hi viewers, welcome to Fund Review. This video is an introduction to mutual fund for beginners. If you are a newbie or a beginner in mutual fund market but you want to have an idea about the various nuances in mutual fund market, then this video is tailor-made for you. If you closely follow the explanations in this video will act as a guide for you to invest in mutual funds. Let's proceed further into the video. Yes, this is going to be the agenda for our video today. We'll be starting our discussion by defining what is a mutual fund, followed by the various ways and means of investment in mutual funds. And then there will be the discussion on classification of mutual funds. Here I would like to highlight that this classification is not a static one. It is a very dynamic one. It varies with the various contexts of investment. In this particular video, I have explained a few contexts which I personally feel is very important for any investor to know before investing in mutual funds. Then there is this explanation on different types of mutual funds. Finally, we will be winding up this video by seeing how to identify the ideal investment for you. Yes, before going to define what is a mutual fund, let me just walk you through an example. Let us consider an individual named Tom. So Tom is basically a salaried employee and he wants to expose himself into the capital market. So he opens a demat account with all proper KYC and then he buys few equity shares. So once he bought these equity shares, Tom didn't had the time or expertise to do all the fundamental analysis and technical analysis. So he didn't do all those analysis, and let's say after a period of 6 months from the time of his investment, one day he opens his account and see the returns generated, and he was shocked to note that his capital got eroded by 50%. So what is the mistake that Tom had done in this part? So he had entered into a market where he didn't had the time or expertise to calibrate or to measure the performance of his investment. So here is where a mutual fund comes in rescue. So mutual fund is an investment vehicle where an asset management company called the AMC pools investment from various investors like you, me and Tom who have common investment objectives. So the key word to notice here is the common investment objectives. So viewers, investment objectives varies from people to people and also from time to time. A person who is in his formative stages of his career may not be having the same investment objective as that of a person who is having decades of experience. And also, if you ask me, the investment objective that I'm having today may not be similar to the one which I'll be foreseeing after 5 or 10 years. So it varies from people to people and also from time to time. So people who are having common investment objectives like achieving long-term capital appreciation or achieving short-term returns, they go for one particular fund which is having an investment objective which is in line with their own requirements. So investors have pulled in their money into a particular fund, and then comes the role of a fund manager who professionally manages the pooled sum of money by way of a strategic investment to achieve the investment objectives. So here in place of Tom, there is an equipped person called the fund manager who professionally manages this pooled sum of money. So this is basically a service which is provided by the investment house through the fund manager, and for the service the fund house charges a fee to manage the fund, and this fee is based on the expense ratio. Yes, this expense ratio is an important term. I'll be explaining in detail about this expense ratio in our forthcoming videos. I'll be making a video on the performance analysis, how to do performance analysis on any mutual fund. There I'll be explaining this expense ratio in detail. For now, you just remember this term, expense ratio. So this is a brief introduction about mutual fund where I tried to explain various players and various terms involved in a mutual fund. Let's proceed further to have a deep idea. Yes, then there are these two categories of common ways of investing into mutual fund. One is the systematic investment plan mode and the other one is the lump sum mode. So this SIP mode is much like the RD account that you're opening with the bank, where you'll be paying recurring installments, and you'll be getting, in case of RD account with bank, you'll be getting the returns based on the prevailing interest rate. But in case of mutual fund, the returns will be based on your fund's performance. So this SIP mode is meant for people who are looking for wealth creation, wealth creation or wealth generation, we can say. Whereas the lump sum mode or one time investment mode is meant for those people who are looking to multiply the wealth. Like it's like people invest a lump sum of amount as a one time investment and they expect to multiply that investment. Here there is no concept of recurring investment. So this can be similar to the fixed deposit that you are keeping with the bank. However, here there are no assured returns based on interest rate. Here also the returns will be based on the fund's performance. Yes, then there is this another classification of mutual funds under the same umbrella, open-ended scheme and the closed-ended schemes. So in open-ended scheme, the investors are free to purchase and redeem their units of investment at any point of time. Whereas in case of a closed-ended scheme, purchase and redemption of units can be done at only at those points or those intervals of time stipulated by the mutual fund house. So this is the only one contrast between open-ended scheme and closed-ended scheme regarding the interval or the point of time for purchase and redemption of your units. So viewers, when we try to classify the mutual funds based on our investment goals, these will be the four categories that will be landing it. First one will be the equity or growth funds, followed by the debt or income funds, liquid funds, and tax saving funds. We will be discussing in detail about all these categories in our forthcoming part of this video. So let's proceed further. Viewers, let us consider an investor who is having a surplus chunk of money in his savings bank, which is idle, and he wants to invest it. And also, apart from this savings bank account money, he's also having another investment to take care of his emergency needs, say emergency medical needs or whatever it is. So, apart from the surplus money, his emergency needs are also taken care of. So he wants to expose himself into the capital market using this surplus amount of money that he is having. And for this particular investor, since his emergency needs are also taken care of, and even after that he is having a surplus set of money, we can safely say that his risk appetite is very high. So for these kind of investors, this style of investment into growth or equity funds are ideal. So what happens here is the fund manager invests a considerable part of the pooled investment in equity shares and other sectors. When it comes to equity, you have to keep yourself invested. The time horizon of your investment should be on the higher side. You have to keep yourself invested for a longer period of time to beat the inflation and generate returns that are higher than the returns generated by the traditional fixed income securities. Since to generate higher returns, you cannot liquidate your investment in a shorter period of time. This kind of investment is having a higher risk appetite. The in a shorter period of time, you may expect negative returns as well. So this kind of investment is advisable for those kind of investors who are having surplus idle money and also having a higher risk appetite. Now let us consider another kind of investor. He is having a surplus money, but he is not having a risk appetite. Let's say he doesn't want to lose that surplus money. So in that kind of situation, you have to go for this income fund or debt fund. So here what happens is the fund manager distributes the pooled investment in a mix of bonds, certificate of deposits, and other debt instruments. So these funds have a typical history of earning more returns than the fixed deposits that you normally keep at the banks. And at the same time, these funds are best suited, as I told you, for investors whose risk appetites are low and expecting moderate returns. Then comes the next category of funds called liquid funds. So here the fund manager invests the pooled investment in short-term fixed interest gaining money market instruments like treasury bills or commercial papers. So here the returns generated are comparatively lesser than that are which are generated in equity or debt funds. So this is much like parking your funds in your savings bank account, but you can expect better returns than the saving returns which are generated in your savings bank account. So here the fund value does not fluctuate much with respect to the market volatility. So here the risk is relatively less, so as the returns. Then the final categorization of funds is that tax saving funds. These are also called equity linked saving scheme. ELSS is the term. So the objective of these funds is to aid the investor to generate wealth as well as to save tax. So here these funds come with a minimum lock-in period of 3 years. So here the investments are done predominantly in equity shares. So this category is ideal for salaried investors who want to save tax as well as to generate a long-term wealth. Friends, we have now come to the final part of the video, which is nothing but the ideal investment for you. So these are the factors that you have to keep in your mind while going for investment in any kind of mutual fund. So it starts with your investment goals, whether you're going to generate a long-term wealth or you just want to park your funds in a liquid fund instead of savings bank account to just generate better returns than a savings bank account. Then comes the type of money that you are going to invest. So this is one of the critical factors. Like if well, you have to keep in mind whether you are going to invest your surplus idle funds or you are going to invest your emergency funds, and your investment strategies have to vary with the type of money that you are going to invest. and then your risk appetite, whether you can, how much of the amount that you can afford to lose in this as a part of your investment. As I have told you, one more important factor that you have to keep in your mind is that your risk is directly proportional to your returns. And then the investment tenure, like how long can you keep this money invested in the fund. So if you're going to generate a long-term wealth, you have to keep invested typically for say 7 to 10 years to see, like considerable returns in your investment. And then the investment objective of the fund. This is a very, very critical, my friends. The investment objective has to be in line with your own, investment goals that you are going to achieve personally. And then finally, you have to, whatever investment that you are making, by considering the above factors, you have to calibrate them with these performance metrics. I'm going to make an exclusive video on how to calibrate the performance of a mutual fund. Don't miss out. With which that video will particularly help you to appraise your investments in various mutual funds. So with this, friends, I wind up this video. If you have any queries or suggestions, please do mention in the comment box. See you in the next video. Thanks very much. Bye.